Hi, my name is Nurrul Adilah binti HASNORRUL HADI from JBA 2422B. Today, I will present about the foreign exchange market and money market.
Meaning for money market are market for trading of short-term securities where short-term funds are loaned and borrowed. Then, meaning for foreign exchange market is a market where buyers and sellers transact convertible currencies, foreign currency.
For the first characteristics of forex is highly liquidity. The currency is considered to be the most widely traded financial instrument across the globe, making the forex market highly liquid. Second, 24-hour market. It is by far the largest financial market in the world and is comprised of a global network of financial centers that transact 24 hours a day, initiating the active trade and exchange of currencies at any time. Third, international network of dealers. The foreign exchange market establishes a medium among the dealers and also with the customers. They are dealers institutions located globally to carry out the exchange and trading activities. Next, for the first characteristics of money market is liquidity. One aspect of money market securities that many investors find very important is the high degree of liquidity they have because to trade for short term. Second, short term. It is a market for overnight short-term funds and instruments having a maturity period of 1 or less than a year. That means maturity is low. It is not a place like the stock market, but an activity conducted by telephone. The money market constitutes a very important segment. Third, lower interest rates. Money market mutual funds are subject to lower interest rates compared to rates offered by other capital market instruments because of the underlying assets and because they are dependent on the applicable market interest rates. For the first rules of forex is transfer function. The basic and the most visible function of foreign exchange market is the transfer of funds, foreign currency, from one country to another for the settlement of payments. It basically includes the conversion of one currency to another, wherein the role of forex is to transfer the purchasing power from one country to another. Second, hedging function. The third function of foreign exchange market is to hedge foreign exchange risk. The parties to the foreign exchange are often afraid of the fluctuations in the exchange rates, the price of one currency in terms of another. The change in the exchange rate may result in a gain or loss to the party concerned. Third, credit function. Forex provides a short-term credit to the importers so as to facilitate the smooth flow of goods and services from country to country. An importer can use credit to finance the foreign purchases.
For the first rules of money market is entrepreneurs provide facilities for adjusting portfolio over the short term by enabling firms to matching the cash inflow and outflow to investment in instruments which suit their investment horizon. Second, help for the government. The instrument that helps government in borrowing short-term loans from money market is treasury bills. It is a low-interest instrument. It helps the government by availing low-interest loans and also a secure investment for the investor to facilitate the government to implement monetary policy and funding of debts. Third, to maintain appropriate level of liquidity for operational of working capital purposes. This is important so that the financial institutions and corporation will not miss the opportunity to gain interest on idle funds, nor they fall into higher cost funding when liquidity is tight.
The participants in forex are central bank, commercial banks, foreign corporation, and individuals and small businesses. Then, for the participants of money market are the central government, commercial banks, business corporations, and individual through NCD, mutual fund, etc. In the year 1967, Currency Board as the sole currency issuing authority. Then June 1967, Bank Negara Malaysia assumed sole power to issue currency. 1968, International Gold and Exchange Crisis. Next year's in 1972, adoption of USD as the intervention currency. In 1973, adoption of floating rate exchange system. Next year, in 1975, change of name of the Malaysian currency. So, in years 1975, floating rate system based on basket of currencies. Besides, in 1989, implementation of SWIFT in the Malaysian financial system. After that, official symbol of ringgit denoted as Ringgit Malaysia in 1992. Then, in 1998, ringgit pegging at USD 1 equals to 3 ringgit in 80 cents, following the selective exchange controls. So, in 2005, removal of ringgit peg to USD, a direct link between rentas and USD chats for settlement of US dollar in year 2006. Next year, 2010, direct quotes between RMB and Malaysia ringgit on the China foreign exchange trade system. Last 2013, renminbi liquidity facility. In the year 1995, issuance of Malaysian Treasury bills. Next year, in 1973, commencement of weekly auction of MTBs. So 1973, abolition of administered interest rate. After that, 1979, introduction of bankers' acceptance and negotiable instruments of deposits. Besides that, introductions of Kuala Lumpur interbank offer rate in 1987. So in 1987, introduction of principal dealership system. In the years 1991 until 1992, active use of unsecured direct borrowing by the bank. Lastly, 1993, introduction of Bank Negara bills BNB. The first legislation of Forex are the Exchange Control Act of 1953. The Exchange Control Act of 1953 consists of guidelines to how Malaysians deal with foreign exchange related commodities like gold, securities, and currencies, and also gives direct restrictions connected to them. In addition, it also regulates the import, export and transfer of commodities or properties. Second, the Securities Commission Act of 1993. The Securities Commission Act of 1993, including latest updates in 2017, gives powers to the Securities Commission Malaysia to license and regulate businesses dealing in securities. The legislation of money market are Money Services Business Act 2011, Act 731. Stronger prudential requirements. The Act introduces tougher prudential requirements for the money services business. Second, about legislation of money market are Anti-Money Laundering and Anti-Terrorism Financing Act 2001, Act 613. Malaysian laws which enacted to provide for the offence of money laundering, the measures to be taken for the prevention of money laundering and terrorism financing offences, and to provide for the forfeiture of property involved in or derived from money laundering and terrorism financing offences, as well as terrorist property, proceeds of an unlawful activity, and instrumentalities of an offence, and for matters incidental thereto and connected therewith. Then, the contribution to economics of money market is increases financial mobility. Aim of a financial system that is in place is to help in the flow of money. So, the contribution to economics of forex are boosting the economy. A country's economy relies on the demand of its currency, basic demand and supply. The better the country's currency is doing in the next forex market, the better its economy will be. And that's all from me. Thank you.